Eric Muathe at Muathe.com, and how we can use failed breakouts and failed breakdowns to gauge where markets are trying to move an instrument. So on the way up, let's say this is a closing high and we have a breakout. So let's say that's the breakout level. Let's call that, just for the sake of argument, 100 points or 100 currencies, whatever currency you're trading. And so if the market was to come and move above this buy point, from a breakout perspective, that tends to be a buy signal. So this is what momentum traders use as a reason to go long. They buy the instrument and they stay in the instrument as long as it is holding above the breakout level, in this example of 100. Now, at the same time, we also know that if it fails, that failure in itself becomes a sell signal, because what generally happens after a failed breakout is prices over time tend to drift lower. So the failed breakout is some type of a warning signal that the stock has run out of momentum. And the exact opposite is true. So let's say a stock makes a closing low somewhere there. So that's the closing low, and then it recovers and stays above that level. So we know that if it ever drops back below this level, and here we are using the closing price, so whatever time frame, let's again call this at 100. So that's the price at 100. And at some point, if it breaks down, then this is where bears take advantage of this drop and find a reason to stay short or to sell the instrument, as long as it is below this threshold line. Okay, now if for some reason at some point the stock recovers back above what was our sell signal line, then this is deemed a good signal to go long, because it means that the stock has run out of momentum on the way down and is now ready to recover. So the idea here is, with a failed breakdown, the next trend tends to be higher. Let's take a look at some examples. So now that we've established the basis for this, we can see here a clear example where this instrument was breaking down but actually did not. This was a failed breakdown, and it subsequently recovered and had a chance for a move higher, which is exactly what happened. Let's take a look at the exact opposite here. And this was the closing high. We come and break out at the beginning of 2016. We spent about a week above that, and then in the following week we fail. That failed breakout is a reason to sell the instrument or to go short, and you can see what happened over time. It's drifted substantially lower. Take a look at another example here, and we have what was an attempt to break down towards early 2015 that failed. By the way, this is a monthly chart, so it seems so you can understand the time frame. So once it fails to break down here and recovers, you can see that that was good enough to start this recovery leg to the upside. And we can also see that there was a breakout attempt that failed. So there's a closing high there. We break out for 2 months. We stay above that, and then we subsequently fail. So once you move back below the previous buy point, looks like a failed breakout. That is a good enough reason to get out of that position, or to sell, or to short. And you can see that in this example, it drifts lower. Let's take a look at one more. All this happened within the same time frame here. There was a breakout attempt, never closes above the buy point on a monthly basis. So all this was a failed breakout this month, failed breakout, subsequently ran out of momentum and started backing away from that level. That was a sign of an instrument that was tired, had used up all its energy, or was now looking to see lower prices. And that's exactly what happened. So that's how we can take advantage of failed breakdowns and failed breakouts. Eric Muathe with Muathe.com. As always, good luck, peace, and blessings. ESCS.